You have money sitting in a savings account right now, and every single month that account is paying you interest, a little reward for being responsible, for being patient, for doing the right thing. Here's the problem. You're losing money, not because of bad luck, not because of some crash or crisis, by design. Let's talk about how that actually works. When you deposit money into a savings account, the bank doesn't just hold it, it lends it out to businesses, to home buyers, to other banks, at interest rates far higher than the rate they're paying you. The gap between what they charge borrowers and what they pay savers is called the net interest margin, and it is the core engine of how banks make money. You are not a customer in this system. You are the raw material. But here's where it gets more uncomfortable. Your savings account has a hidden opponent, one that doesn't show up on your statement: inflation. And for most of modern economic history, inflation has been running faster than savings account interest rates, which means the purchasing power of your money shrinks every single year you leave it there. In 2022, inflation in the United States peaked above 8%. The average high-yield savings account at that moment was paying somewhere around 0.5. You weren't growing wealth, you were watching it evaporate in slow motion. This isn't an accident. It's a structural feature.
Central banks like the Federal Reserve set something called the federal funds rate. This is the rate at which banks lend money to each other overnight. When the Fed raises that rate, banks can earn more by simply parking money with the central bank. When the Fed cuts rates, that option becomes less attractive. Here's what matters. Commercial banks pass almost none of those gains down to ordinary savers. They absorb the upside. They offer you just enough to keep your deposits in place. The asymmetry is breathtaking once you see it. And now, the irony. For decades, savings accounts were marketed as the safe choice, the responsible. What they actually represent is a legal transfer of your purchasing power to institutions that are far better positioned to deploy it. You get the illusion of security. They get the compounding return.
Think about the math over a lifetime. Someone who keeps $50,000 in a traditional savings account, earning 1% annually for 30 years, ends up with roughly $67,000. Sounds fine, except if inflation averaged just 3% over that same period, that money in real terms has lost nearly half its original value. The number on the screen went up. The actual power of that money went down. This is what economists call a negative real return, and it is the default setting for the average person's financial life. Now, there are people who understood this early, who moved money into assets that at least kept pace with inflation. Real estate, index funds, treasury inflation-protected securities, commodities. The returns aren't guaranteed, but they at least entered the arena of actual wealth preservation. The savings account never did.
Here's where the story gets broader. Governments and central banks actually benefit from mild, steady inflation. It quietly erodes the real value of public and private debt. It keeps consumption moving. A population that saves too aggressively slows an economy down. So in a very real sense, the financial system is structured to discourage excessive saving by making it quietly punishing. The savings account exists not to reward you, but to keep your money accessible to the banking system, while giving you just enough return to feel like a responsible adult. That's the design, and most people will live their entire financial lives inside it, without ever noticing. So here's the question that doesn't have a clean answer. If the system is built to erode the savings of people who play by the rules, what does playing by the rules actually mean? And who exactly wrote those rules in the first place?